Hi, everyone, and welcome to the Wealth Wednesday show. It's indeed a blessing to see you once again and happy new month. We believe you're keeping safe and that you are living or becoming financially healthy every single day by watching our videos here on YouTube. So, if you haven't subscribed to our channel, I would encourage you to press the subscribe button right below you, turn on notification so that you can be able to be notified every time we upload a new video or we go live like right now. So I would love to hear from you. Where are you watching this live video from? You can send us a hi and say where you're watching or listening me from as we get to discuss on the fundamental pillars of investing. But before we can go right in, I would like to really appreciate each of you, both our followers on Facebook, Instagram, and here on YouTube. You guys, you really make the Financial Wellness Center brand to be inspired every single day by your commitment and loyalty to us, our products, and our services. So, if you haven't followed us on Instagram, please go and check out Financial Wellness Center and follow us. We shall be following you back right away, as well as you can check out our Facebook page, Financial Wellness Center, so that you can stay updated with business and money management tips. So, we will go in right away to today's topic of discussion, which is fundamental pillars of investment. We've seen quite a number of people, even it could be you yourself. When you started your investment journey, you did not know much about investing, and maybe you just started investing because you had people are investing, or maybe somebody told you, like, um you need to start investing, so you just started because you had to, or you had someone telling you to do that. And this, in a way, you did not take much interest or concern on the fundamental pillars or principles that you need to be aware of when it comes to investing, so that you don't end up making some mistakes or missing out on something. And as a result, we've seen most people, since they did not know most of the financial investment fundamentals, they they end up making quite a number of mistakes, while others end up missing out on very great opportunities that could have helped them to move forward in their investment journey. And for that reason, I decided to do this live video just to help us get to understand on what are these fundamental pillars of investing. What is that one thing that I need to know before I can commit my money either for a long term or short term investment instrument or portfolio? So that is what we'll talk about today. So I will encourage you to keep on sharing sharing the link to your network, invite as many people as possible. Because as I always say, when you learn alone, when you get to acquire these principles alone, as a human being, sometimes you forget. So you might forget quite a number of things, but if you learn with someone, you can be able to help each other. Maybe let's say complement each other, so that if one person forgets principle A, the other one will remind the person of principle B, and with that you'll be able to keep on going forward. So when it comes to investing, we've seen a lot of people, most of us, we are always told to invest while you're still young, when you still have that income. Um, a lot of people, you'll be told by most people, or even you yourself, you'll feel that they need to invest so that you can have a secured future, or you can be able to make an income aside from your main um, aside from your main source of income. So the first thing when it comes to investing, in order for you to experience or become a successful investor, there are two things that you really need to focus on. And being a successful investor doesn't really mean that you're making millions or billions, but it means that you are able to be consistent with what you're doing. You are able to stick to your investment plan. You are able to enjoy returns of your investment. You are able to tell um, how you're performing investment wise. In such an instance, we will consider you a successful investor. So if you're starting out in your journey, I know there are a lot of people, especially the millennials like me, we are still on the journey, right? So we are still working on becoming better every single day. That doesn't mean you will not be a successful investor. You will, as I said earlier, you are considered to be a successful investor so long as you fulfill the some of the conditions I've mentioned. Of course, there's a time where you are considered as a veteran successful investor, which of course it takes years. That's when you start seeing very huge returns and you are able to really like have a very nice portfolio. But when you are starting, you still can be considered a successful investor if you are able to meet the conditions I've just stated earlier. Now, when it comes to becoming a successful investor, there are two things that you need to focus on or you need to have for you to be able to experience this. And number one is planning. I know most people, they don't want to hear the word planning. They say they are living life as it comes, which if that is your policy in life, that is okay. But to become a successful investor, you need to be a good planner. Things just don't happen overnight. You need to plan. Wealth just doesn't come overnight. You need to plan things so that you can make them happen. So to become successful in terms of investing, you need to be a good planner. And number two, you need to have discipline. So I'll first of all explain what I mean with planning, then I'll go to discipline. So when it comes to planning, you need to but being a good planner means that you carefully think about everything you need to consider when developing your investment plan. So you just don't wake up today and say, okay, my investment plan for 2021 is ABCD, and then you start. You need to take time, sit down, carefully think, where do I want to be in 2021 by the end of the year? What do I want to achieve? Then what kind of investment tools do I need to invest in? What do I need to know? What kind of resources do I need? What kind of income do I need to have? That is planning. So when you come up with your investment plan, you already know how, where, and when. Then the other side of planning is this is under planning. When you are able to carefully think on the things you need to consider when coming up with your plan, there are things that you'll need to, that will come up, such as defining your goals. So under planning, that is a very fundamental pillar of investing. You need to plan. And under planning, we have defining goals. I know the year just started. We've heard about setting goals, setting smart goals, and all that. So I know most of us know about goals and all that. So it applies when it comes to investing. You need to you need to have a defined goal. For example, I might say by the end of 2021, I want to be able to have saved amount XYZ to invest in tool ABC. So you see, I have a goal. So I'm not just saving money because everyone is saving. I'm not saving just because I have disposable income. I'm saving because I have a goal of acquiring investment ABC. So if you want to become a successful investor, it's very important to define your goal. Why am I investing in ABC? Maybe I'm investing in ABC because of my retirement. I'm investing in ABC because I need my child to get to be able to fund my child or children's college fee, or I'm investing in ABC because I want to be able to have more time on my disposal to do the things that I love. So under planning, the first thing you need to do is define your goals. Then the second thing is in be able to define your investment time frame. This is where a lot of people tend to mm, this is where a lot of people tend to assume, but it's important for you to know, uh, if I'm going to invest, is it a long-term affair? Is it a short-term affair? And if it's long-term, what is my long-term? Because you can't find, my long-term could be 30 years. Another person's long-term is 15 years. So you need to define your investment time frame. How long am I going to invest in this tool? How long am I going to hold my money in this investment tool? So once you're able to define your investment time frame, now you are able to know what kind of tools you will be able to commit your money. Now, when it comes to defining an investment time frame, it's very, very important. For example, there are investment instruments that their nature is only for short term. Now, if you're looking into investing for long term, if you go and invest in an instrument that its nature is for short term, trust me, you will feel like this investment instrument is a scam, but the real thing or the real deal is that you invested in a long-term tool with a goal of with a short-term goal. So it's very important to define your investment time frame. How long do I want to invest? How long do am I able to hold this investment? And then from there you can be able to know, now if I'm going to invest for short term, I have option ABC. If I'm going to invest for long term, I have option ABC. Then the next thing under planning is looking after your understanding asset allocation. Now, remember, as I started earlier, I said the fundamental pillars of investing. Number one is planning, and number two is discipline. And we are now breaking it down under planning. And I've said the first one is you need to define your goal. The second one, you need to have to be able to define your investment time frame. And then the third one is understanding asset allocation. Now, asset allocation is very, very important. You need to know what is in my portfolio. I always say when it comes to investing, it's like having a bag of fruits. If you're gonna carry around a bag of fruits and you don't know what kind of fruits are inside there, if at any point anyone will tell you, I need a certain fruit, maybe a mango from your basket, if you didn't check, you will not tell that person if you have it or not. So this is the same when it comes to investing. When you're investing, it's like you're having an empty bag and you're putting inside fruits of different kinds, that is different portfolios. So maybe in your investment journey or investment bag, you decided you will invest in real estate, invest in stock market, you'll invest in business, you'll invest in what do you call this, precious metals, etc. So you need to understand asset allocation. What kind of asset am I allocating to my short-term basket? What kind of assets should I allocate to my long-term basket? So when you are able to understand asset allocation, we realize you won't even need an investment manager. However, if you haven't, like, you don't know much about investing, I would recommend you contact us, Financial Wellness Center, and we can walk the journey with you. Or you can get yourself an investment advisor or manager who can manage your portfolio and guide you, especially to help you understand asset allocation. This is a segment that most people, especially advisors, don't mention it to you, but it's important for you as an investor to know what kind of assets and which assets to allocate where. As I said earlier, not all assets are are good for long term, and not all assets are good for short term. So you need to know what kind of assets do I have, how do I allocate them, and this will also help you when it comes to when it comes to I've forgotten. It will help you when it comes to knowing what kind of resources to allocate in a given asset. Example, if I have identified that in my short-term investment goal, the assets that I want to have is maybe, let's say, highly volatile assets like the stock market. So what will I do? I will say, since it's highly volatile and maybe it's a short-term thing I want, I'll not put a lot of my money in it because it's very risky. So when you are able to understand asset allocation, the risk factor comes in. You are able to know or to tell, like, this is so risky, so I'm not going to put most of my resources there, or this is less risky, I'm going to put more of my resources there. Then, and the other thing, well, you need to consider while planning on your investment journey or portfolio or journal, it's looking after your investment over time. This should be included under your planning. Now, we've seen quite a number of people, they start very well in investing. They invest, absolutely. But the thing is, they don't look after it. So you find that someone, they they tell you, like, I have quite a number of investment, but I am not sure how everything is going. Or just because you're getting some returns, you don't check over time. It's very important for you to include how you are going to look after your investment over time. Why? Because when you are able to include that in your plan, you'll be able to sit down after 6 months and say, okay, in these 6 months, I've invested in instrument ABC. How has it performed? Maybe it's not performing well, or maybe it's time for me to put a break, or maybe it's time for me to maybe increase the income I'm putting there. So it's important for you to include in your investment plan setting aside time to look after your investment over time. Don't just invest then forget. I know a lot of people say, oh, yeah, I put my money there. I put my money in a circle, so I'm just waiting for the dividends, and I just don't look at it. And this also counts when it comes to checking your statements. If you have any investment account, whether it's for stock market, bank accounts, circles, whatever, it's very important for you to always review and see how are they performing. Do you need to increase? Do you need to reduce? Do you need to put a break? Because investing is it's a very fluctuating thing. There are things that were so good in investing in 2020, but you might find in 2021 they're not good anymore. So you need to keep on changing your strategy every now and then. And this can only happen when you have a plan set aside to always review or look after your investment over time. And this leads me to one of the things I've always heard from most of our customers. They usually come and tell us, my dad had stocks or my mom had stocks in or shares in ABCD, but we are not sure how many or how much. You see, it's clear that when this person was investing or creating their investment plan, maybe the person was investing for the children, but he or she did not include in the investment plan, looking after the investments over time. And when you include looking after investment over time, you are able to even review your beneficiaries every now and then. So you don't end up leaving people in a dilemma, because sometimes you'll get old and maybe let's say you are 90 and you invested maybe in shares since when you were 25 or 20. You can't tell me you still remember that, but if you kept on reviewing over time, I'm so sure within, when you were like retiring, you are able to change your beneficiaries and let them know, like, I have A, B, C, and D. So it's very important to include in your investment plan the aspect of looking after your investment over time, and especially for long-term investments. For short-term investments like those ones for 3 months, 6 months, okay, that one you may not like really consider that much. But for long-term investments like 5 years, 10 years, 15 years, you need to really keep an eye on everything, just at least to ensure that you are not losing out on certain aspects. So that is all about part part A, that is planning. So we go to part B. Remember, as I mentioned earlier, we are discussing on the fundamental pillars of investing. So this, and I say the first pillar is planning, and the second one is discipline. Now, if you've ever enrolled in a health fitness challenge, I am so sure your coach or your trainer or your gym instructor, the first thing they tell you is discipline is key for you to see results. Now, for example, if you're going to enroll in a fitness challenge or journey, health fitness journey, if you go and exercise today, then the same day you are eating junk, the same day you're doing all kind of things that you're not supposed to do while you are trying to become healthy, you will find that even after 6 months you will not see any results. Even if you'll have the best um, tools for becoming healthy, even if you'll have the best trainer in the world, if you are not disciplined. Another example is, if you are going to do let's say the same health fitness, if you'll not be exercising, let's say maybe 3 times a week or every day, you don't expect to see results. You cannot come back to your trainer after 6 months and you've not been exercising as required and tell the trainer, like, why am I not seeing results? Yes, you have not been consistent, or you did not exercise discipline. So it's the same applies when it comes to investing. In investing, discipline is very, very important. I know we are in a world that is full of a lot of things. A lot of things have been happening around us, especially with this pandemic. A lot of people have gone through very, very challenging things. And sometimes you might find yourself not being able to be disciplined in your investment journey. But I always say you don't need to beat yourself up. What happens in your investment journey, you fall and rise. You need to in, incorporate that yes, I may fall, but I have to rise again. Yes, I may put a break because of certain issues or emergencies, but I'll try my best and bounce back. So what is discipline? Discipline means keeping market movements into perspective, recognizing the potential impact of risk, and regularly rebalancing your portfolio. I will repeat, when it comes to investing, having investment discipline is very important. And investment discipline means keeping market movements into perspective. What does that mean? That means you are viewing the market in various perspectives or dimensions. Sometimes you might find, when you view the market, for example, in 2020, when the stock market came crashing down, if you are a disciplined investor and maybe when you were setting up that investment plan, your goal was a long term, you're investing in the stock market as a long term thing, you will find that even if the market was crashing, you would view it in two ways. You would say, okay, in the short term, for sure, I'm seeing my shares or my stocks going down in terms of value. But if I look at it in the long term, maybe in 5 years' time, this stock might rise. So I'm not going to do anything. I'm just going to remain constant. Or maybe I'm going to add on my portfolio because now the price is down. So discipline is not just about being consistent, but it is also more of you viewing, keeping market movement into perspective. And perspective doesn't just mean one way, it means to see things in various ways. I always say it's not all the time that the crowd is correct. Just because everyone is telling you about Bitcoin or everyone is buying GameStop shares, it doesn't mean that you need to do the same. You have to, to view it in your own perspective in accordance to your goals. Once you do that, then you are able to become a successful investor because you'll be able to stick to an investment plan regardless of the storms that come when it comes to investing. Then the other meaning of discipline in investing is it means that you recognize the potential impact of risk. Now, I always say investing is a risk. I can't say that we have 100% risk-free assets. I guess it was yesterday I did a post on Facebook where I said if a stock gives you constant returns for continuously, then it is considered to be risk-free. But that doesn't mean it will be 100% risk-free. So when you get into investing, when you're planning to start your investment journey, it's important for you to recognize the potential impact of risk. Now, how do you recognize the potential impact of risk? You do this by sitting down and saying, okay, I'm going to invest in instrument ABC. For example, I'm going to invest in money market funds. Now, if I'm going to invest in money market funds, what is the potential impact of risk? What will happen if there will be a risk that will occur? Am I going to be able to handle that risk? And what kind of risk is going to happen? Is it a high risk thing? What kind of impact will the risk bring to me? Because sometimes you find someone is because of excitement, they invest in something and they don't think or sit down to analyze the impact of the risk. So when the risk happens or something happens to the investment and they lose it, they become sick, or they become devastated because they did not analyze the impact, the potential impact of a risk associated with that investment. Example, you find someone, since they've heard everyone is buying stocks or shares of a certain company, and of course they've even maybe seen it here on YouTube with YouTube ads saying buy this stock, everyone is buying, people are getting this income, so they end up buying that stock. Now, they did not sit down to recognize the potential impact of risk associated with that stock. So you find they put a lot of money there. Now, if this stock doesn't perform well, or they don't recognize that this is a highly risky investment or asset I'm taking up, and I might lose all my money or I might gain more than I invested. So on the negative side, if anything happens to that stock or share and they lose all the money they had put there, you find that the impact is small. Or another example is you find someone taking their the money for their expenses, monthly expenses, to invest in a highly volatile market. Now, example, if I'm gonna take maybe money meant to pay my bills and invest it in a highly volatile market, and for some reason, this highly volatile market on that month, it goes down. So it means I will lose the money that was meant to pay for my bills. So what is the impact? The impact is I'll not be able to pay my bills. And what was my mindset when I was investing? I was investing in that asset with the aim that I'll make quick profit and be able to maybe take out my principal plus the profit, or use the profit to pay for my bills, and of course maybe enjoy. But if it happens the other way around, if that asset doesn't perform as I expected or as I forecasted, what kind of impact will that risk have on me? So it's very important when you are planning or starting out your investment journey. It's good to check on the investment discipline. And I've said that this segment is more of recognizing the potential impact of risk that asset can bring to you. I've always said do not invest, especially in highly risky markets like the stock market. Do not use your grocery money to invest in stock market. Just because people are saying like buy this share today, buy this share today. If you do not have money for that, don't use your grocery money or school fees money or emergency fund to buy, to invest in highly risky assets. It will end in premium tears. I heard someone saying premium tears. I don't know what that means, but it will not end well. Then the other aspect of discipline when it comes to investing is regularly rebalancing your portfolio. Now, as I said earlier, under planning, it's important when you are setting up your investment plan, you need to include looking after your investment over time. Now, on the discipline segment, it's important for you to regularly rebalance your portfolio. Now, what do I mean? Because it sounds like a very, big jargon, but regularly rebalancing your portfolio means I'm gonna sit down and look after 6 months. So let's say for example, I've decided to invest in assets A, B, C, D. Okay, now after 6 months, I need to sit down and check. I invested in asset A, B, C, D. How are they performing? Now, do I need to shift the resources I put in asset D so that I can top up asset A because asset A seems to be performing well? Do I need to reduce the resources I'm putting in asset B to put them in asset C because asset C seems to be promising? Do I need to add other assets in my portfolio? Why am I saying you need to do this? It's because you need to constantly check how you can rebalance. Please remember that not all investment tools or not all assets can give you the same returns. So it's important for you to see if I'm going to invest in four different assets, and one of them is giving me little or minimum returns, then I need to include in my portfolio an asset that is able to give me more income, so that in case the asset that gives me minimum returns doesn't perform very well, then the asset that is able to give me more returns can cover it up and uphold my portfolio. I'm trying to think of an example. Let's say, for example, you've decided your investment portfolio includes stock markets, real estate, precious metal, money market funds, and government papers or government bonds and bills. Now you realize that these assets they are a mixture of risky and less risky. That is number one. You also realize that these assets, there are some that will give me higher returns and others will give me less returns. You also realize in this portfolio that I've just given us, there are assets that are suitable for long term and others are suitable for short term. So as a potential investor, if you want to become successful in investing, you need to regularly rebalance. Don't just put your money or commit your money in a certain investment and go and sleep. You need to constantly or regularly check. I always say, always check after every 6 months or 3 months and see how are my portfolios performing. Maybe you've invested in the five assets I've just mentioned. You need to see how have they performed. Maybe the money you put in the stock market is not giving you enough returns, so it means you need to change, you need to do something. Maybe the money you put in your money market funds it's less, yet you see the returns are kind of high, so you need to remove the money in the stock market and shift it to the money market funds. So it's important for you to regularly rebalance your portfolio, because when you keep on doing that, then you are able to kind of boost your returns. And now this also depends on the long-term and short-term assets you've invested in, because you'll find that there are assets when you regularly rebalance your portfolio, you'll find that maybe there are assets you put in your short-term class, yet you find that they are more productive or they are able to bring you more income when they are under a long-term category. So it's very important for you to always rebalance your portfolio. Don't invest and then you go disappear and show up after 2 years or 5 years to to know what is happening. You need to come up with something that um, can be able to keep you on toes so that you can regularly rebalance your portfolio where need be. And sometimes you'll find when you're checking your portfolio, you'll find out that there are certain uh, assets you need to get out. There are certain investments you need to step out of them because they are no longer giving you value as at that time or as expected. So it's important. Don't just invest and go to sleep. Always check, because as I said, investing is very dynamic. You need to constantly re-strategize, and you can only be able to re-strategize if you regularly check on your portfolio. So as I said, there are assets that were so good in, let's say, 2010, but they're not good anymore in 2021, or they are not in line with your goals, because we are also changing. You might find there are things that change in our lives. Maybe your income has increased, so the same asset that you are having in 2010 when your income was less, it's not the same asset you'll have when your income has increased. It will need to upgrade. So it's important for you to always rebalance your portfolio. Now, with that said, I would also like to highlight that it's also important to live within your means and decide how much you'll set aside for investing before you start to develop your plan. And this is where I have seen with the many clients I've handled, I think thousands, this is where they fail. And it's always very devastating and heartbreaking when someone comes to you and tells you, Sheila, I decided to invest in asset ABC. I started very well, but along the way, something happened and my income was not enough to fund that investment. So I ended up losing the investment plus the money I had invested in it. Another one will tell you I invested this money and I took up this investment, and as a result, I'm now not able to I'm now not able to cater for my day-to-day expenses or monthly expenses, or I'm not even able to pay my children's school fees because I'm investing. So it's very, very important for you to always live within your means. If you know you are not able to raise money for $1 million investment, don't go there. Start with what you can afford, then build on it. There's no need for you. We are in a world where everyone wants to flaunt they are wealthy. They want to make a point that they can afford certain things, they are able to invest in certain things. But you come to find that this person is actually not able to do that as at that time. They need to start on a step by step basis. So always live within your means when it comes to investing. Actually, I should have said it's important to invest within your means, not live. Living within your means is more of budgeting, but investing within your means is very important. It doesn't make sense for you to go out there and start an investment journey, then get stuck in the middle because you do not have funds to continue, or you're just not able to fully pay for that investment asset to acquire it. So it's very, very important for us to invest within our means and always decide how much you'll set aside for investing before you start to develop your plan. Now, this is where again some people tend to overlook, but if I want to see results, as I say, discipline is very important. If I want to see results by the end of 12 months, then I always say investing should always appear in your monthly budget in case there is not you're not experiencing any emergency. So for example, your monthly budget should always have maybe 5% of your income allocated to investing. Then, so every month, I have 5% set aside for investing. Then you go and now look at in this 5%, maybe 3% goes to long-term assets, then 2% goes to short-term assets. So you need to always set aside something, decide how much you'll set aside for your investing. Don't just wake up today, then you're taking everything, you're withdrawing everything and deciding, okay, I'm investing in this thing. It's that one is not really advisable because it will cause shock to you, and I always call it financial shock. It will cause financial shock to you and to those around you. So it's very important for you to decide how much. And this again reflects back to our initial point of planning, where I said you need to define your goals. Part of defining your goal is by knowing how much I'm going to set aside for investing this year or for this quarter. So I'm going to say maybe I'm going to be setting aside 5% of my income to invest. So when I'm creating my investment plan, I have a dedicated amount of money that I am committing myself to be setting aside for investment. And now this is where the idea of saving comes in. Don't just save because everyone is saving, or just save because you want to feel good. Save with a goal and save with a reason. So with that said, I have a lot of things to say, but due to time, I think we'll have to do another video later on. But it's very important for you to understand these fundamental pillars. As I said, I've just given us two of them, but if I get more time, I'm gonna do another video where we'll discuss more deeply on investing in the and more principles that you need to always check before you can commit your money. So Just to recap what I said the fundamental pillars of investing. Number one is planning, and number two is discipline. Then under planning, we said we have defining your goals, defining your investment time frame, and understanding your asset allocation, and looking after your investment over time. Then under discipline, we said you need to keep market movements into perspective, and we also say that it's important to recognize the potential impact of risk, and you need to regularly rebalance your portfolio every now and then. And I winded up by saying it's important to invest within your means. Don't invest outside your means. Just because your friends are investing in certain things because they have the financial capacity, if you do not have that financial capacity at that time, it's okay to say no. I'm not able to afford the amount of money to invest in this thing now, but I'm going to work on it, or I'm going to start small, then build on that. So don't just give yourself pressure because you want to join a certain class of people, yet your financial capacity does not allow you yet. And I finally said it's important for you to decide how much you will set aside for investing before you can actually start the journey. So until then, I believe we have all benefited from this live session. If you're gonna watch us later, please leave me a comment in the chat box and let me know what other investment pillar do you think we need to consider when it comes to investing, as well as if you have any question, I will be available in the chat in the comment section. So just write us your question, and we'll get time to look through it and answer you as in the best knowledge possible. Um, until then, I'll see you next Thursday. Please keep on subscribing to our YouTube channel. Ensure you invite as many friends as possible to subscribe to our channel so that they can get to learn. This is a month of spreading love and kindness, and one way you can spread love to the people you treasure so much is helping them become financially literate. So, and we have made it possible for you by uploading a lot of videos on our YouTube channel. So you may not be able to gift them monetarily, but you can refer them to our channel and let them know that they can acquire a skill or two on money management here on our YouTube channel by subscribing, and it will go a long way, because money is something all of us handle every single day. Unless you're a toddler, that's when you don't handle money. But so long as you're an adult, money is here to stay, and we are here to use it and handle it. So it's very important for us to know how to handle it so that it does not become a tool that hurts us rather than helping us. So until then, keep following us on Instagram at Financial Wellness Center. It's been a pleasure sharing with you on the fundamental pillars of investing, and I hope you have benefited from this live session, and I look forward to seeing you next Wednesday. We shall be having a very interesting topic next Wednesday, so stay tuned by subscribing and turning on notification, as well as follow us on Facebook. That is where we always share our updates so that you can stay updated and be in touch with us. So until then, I wish you a very blessed month. May you continue living financially healthy. To those that keep on sharing your testimonials with us, we really appreciate you, and we are so happy for you. May God continue blessing you as you continue to become a better money steward. So keep safe. Ensure you are living financially healthy as you invest within your means. Bye.